Want to learn more on how home financing works? Find out next on REI Talk. Ruben Galindo. I'm a real estate agent, a real estate investor out of San Antonio, Texas. Today, I'm here with Andrea Lopez. She is a local lender here in the San Antonio area. Andrea, thank you for joining me today.
Thank you for having me.
Great. Hey, listen, so I got, in the home buying process, whether you're, homeowner looking for that next property or you're an investor, there's obviously lending involved most of the time, right? Unless you have an all cash deal, which is few and far between. As you well know, I specialize with real estate investors. So we typically want to maximize our cash on cash rate of return. So we always turn to these loans. So again, thank you for your time. Thank you for joining me today. And I just kind of had some questions about the lending process. So this will be fun. It'll just be talk is all it is. So first of all, well, tell us just a little bit about yourself first before we get started.
All right. So my name is Andrea Lopez. I'm a mortgage lender with Loan Depot. I've been in the mortgage industry for over 15 years. So I have a little bit of knowledge of the different loan products that we have to offer. I really enjoy what I do, and I love helping people meet their dream of home ownership. It's important to me, and it's very rewarding to see people, get into a home. And so, that's what I enjoy doing.
Great. Well, again, thank you, Andrea. So first of all, I kind of wanted to just kind of go over the different types of loans. So what are the different types of loans that are available normally?
Right. So we've got government loans, we call Govy loans, and those would be your FHA and your VA and your USDA loans. Okay. And then you've got your conventional loan as well. So those are the 5 that are out there: FHA, VA, USDA, and conventional. I'm sorry, 4 that are out there.
Okay. Can we kind of unpack just that just a little bit? What are some of the differences on those type of loans? Because you mentioned, I think you said 5. So what's kind of the difference between them? How do you end up with, say, conventional versus FHA versus VA? I think most people understand VA is a veteran loan, but can you explain that a little bit?
Sure. So each loan program is going to have down payment requirements, credit score criteria. Rates are going to differ between each product. So we'll start with FHA. FHA is a government insured loan, and it is the most popular loan used by first-time home buyers because it's got a lower down payment than your standard conventional. So FHA requires a 3.5% minimum down payment. The credit score criteria is usually low on that as well. We'll go as low as 580 on our FHA loan. So it makes it a little bit more easier for those that are a bit credit challenged to qualify and utilize that loan. Then you've got the VA loan. The VA loan is for veterans who are actively serving or have served in the past, and it's 100% financing. So they do not have to put any money down. It is, again, for the veteran and the veteran and spouse only. And that's a great product for veterans, as it is 100% financing with no PMI, no private mortgage monthly insurance, which we could talk about in a little bit as well. So that's your VA loan that's out there for veterans. Then you've got your USDA loan. Now your USDA loan as well has credit score criteria and income limit criteria for that program, as well as the properties. So the property that you're looking for has to fall under a USDA approved eligible area. And you're going to find that that's commonly your rural areas or smaller towns with smaller populations that they're trying to help build and grow.
So those are kind of location specific or address specific, is that correct?
Correct.
Okay.
Correct. So if you're interested in a USDA loan, there is a website that you can go in and pull a list of all the properties in the area that are USDA approved. Okay. So that you don't go wasting time trying to look for a home in the middle of downtown, because
Yes.
that will not be USDA approved. But if you're looking for homes outside the city limits, St. Hedwig, Guadalupe County, Comal counties, those little Marion, those are usually areas that fall within USDA criteria.
Right.
That program does have a little bit stricter credit score criteria and debt to income criteria, as well as income limits as well.
Okay. Okay. I'll have to get that website. I'll put it in the show notes. That way, if people go to it, they can just click on that link. So
yeah.
Great, thank you. Okay, so you've gone over VA, you've gone over USDA loans, you talked about FHA. Now the conventional, I know there's different down payment. I don't know if it's called requirements or options, I should say, right? On the conventional side. So can you kind of explain that a little bit?
Sure. So your conventional loan product, also known as your Fannie Mae loan product, they do have customarily minimum 5% down, okay? But they do have other programs for first-time home buyers where you can, if you meet the criteria, you could put a minimum of 3% down. Those are called the Home Ready and the Home Possible loan programs. Okay. So yes, you can get a conventional loan putting less than 5% down if you meet the criteria for Home Possible or Home Ready, and go with 3% down. There's also a conventional 3% down standard. So if you're not a first-time home buyer and you don't meet the income limit criteria for Home Ready or Home Possible, because they do have income limit criteria for those programs, you could still get away with a 3% down conventional loan. And it's called the conventional 3% standard 97% LTV. Or, you can go 5% or 20% if you want to avoid having to pay PMI, which is private mortgage insurance, on the conventional loan. The conventional loan is going to have higher credit score criteria. You got to have a 620 or higher to qualify for conventional. Right now, it's looking like you even need a higher than 620 to qualify for conventional. They're getting a little bit more stricter on their guidelines. DTI cannot exceed 49%. And you really have to have, some good compensating factors like really good assets and reserves, clean credit, to meet the criteria for conventional financing. Okay,
great. So you mentioned it already a couple times. You talked about PMI. So let's explain that, because just in case we have a listener out there that doesn't know what PMI is, can you explain that a little bit further?
Sure. So PMI is private mortgage insurance, and it's an additional cost, if you will, rolled into your mortgage loan. Aside your principal and interest payment, your taxes, and your homeowner's insurance, you will pay private mortgage insurance. This is required on FHA loans and on your conventional loans of less than 20% down. And I believe USDA has PMI. I haven't done a USDA in quite some time. Okay. But PMI protects us, the lender, okay? In the event that you default on the loan, that insurance helps us, I guess, in the foreclosure process, if you will. I mean, it protects us, the lender, because there's very little equity right off the bat. You're only putting a minimum 3.5% down. Okay. Now, will it last forever? On an FHA loan, PMI will never drop off at any time throughout your mortgage loan term. It'll remain for the life of the loan until you pay the loan off. On conventional, if you put 3 or 5 or 10 or 15% down, you will carry PMI until you have met an 80% LTV, and it'll automatically drop off at that point.
Okay, I was going to ask you that, because I know conventional, you have to pay the PMI until you reach that 20%. Now, let's make this, I want to make sure that we're clear on this. When you say 20% equity, you're talking about 20% equity from the purchase price, not the appreciation on the property. Is that correct? So what I mean by that is if you buy a house for, say, 100,000, so you got a loan at 100,000, you put 5% down, you're financing $95,000, but your house in the next, say, 5 years appreciates to 150,000, but your balance is only still at 85,000 over those 5 years. That doesn't mean it's going to drop off, does it? Or it will drop off because now you have a lot of equity because the house just appreciated to say 150,000.
Yes, if I am correct, it is off the original appraised value and the balance that you owe.
Yes, that was my understanding. It's kind of where you started, not necessarily including the appreciation. That's what I understood as well. But okay.
Correct. So you can usually do two things. That 78%, if you think you have the equity, you can request that it be removed. And depending on your lender, more than likely an appraisal will be needed to confirm the equity in the home to remove the PMI.
Okay.
At 80%, your lender should automatically remove it at that point.
Okay.
Mm-hmm.
Okay.
Yeah.
So I guess if it's appreciated and you think you have at least 78% is what I'm understanding you're saying, then it may be worth making a phone call to your lender and say, hey, I believe I have, I don't know, maybe 60% equity because of its appreciation. And I guess the lender can kind of look at the appraisal at that point and then reconsider. Okay, all right. Well, that's actually pretty good news that you may have that option to do that. So
right.
Right. Okay. So thank you for explaining all that. Now, what about on the FHA? There's also, what is it, a 203K for repairs? I've never done one of those, so can you explain that a little more?
Yeah, so FHA offers a 203K loan, also known as a rehab loan, a rehabilitation loan. Okay, so what FHA allows you to do with that type of financing allows you to finance what is needed to purchase the home and then take additional funds to do some renovations on the home after you close. Okay. And customarily it's, things that need to be done to bring the home up to par. Maybe foundation, roofing, plumbing. There is a 203K rehab loan that allow you to take out those additional funds for repairs.
Okay.
So that is an option. There is a program out there.
Okay. So with those loans, I assume that there's got to be some approval processes in place. I guess what I'm getting at is that you can't walk into a house. It's not necessarily in the condition where it needs, $100,000 worth of rehab or $50,000 worth of rehab, and then you can go and try to apply for an FHA 203K loan. Is there some limits?
Yeah, there's some limits. So the home still has to appraise with the renovations, and then there's a maximum amount. Now, I personally have never done one. I'd love to do one day. Yeah. But of course, there's a max LTV that they're going to allow you to go as far as, how much they're going to let you borrow.
Yeah.
There's DTI requirements, usually 43%. So it might get a little bit more stricter. Oh, here we go. You can borrow up to 110% of the property's proposed future value or the home price plus renovation costs, whichever is less.
So I guess if you want to try to attempt an FHA 203K loan, it's best that you sit down with your lender, kind of go over it. I would assume you need to know already the subject property and then kind of work it from there, right? Because it's gonna take some time to kind of figure that out, right?
Correct, correct. Usually
Okay.
these are loans, once you've gone under contract, let's say you get the home inspection back and you realize there's some repairs. This would be a good example, unless say the seller doesn't want to, do the repairs. That would be a good time to talk to your lender and say, hey, do I qualify for a 2 or 3K loan? We just found out that the home needs a new roof and the seller's not willing to, put any money into it, and then we would, run the numbers and see if the borrower qualifies. And if so, yeah, that's something they can do. And so the loan keeps moving forward. So it's not, we close and the fund, they can do the repairs after closing.
Okay.
If you're an investor and you're looking to buy an investment property, this loan is not for you. It's only for primary residence only. Because it's still an FHA loan, of course.
Yeah.
But yeah, that is a great rehab loan. Again, I've never done one. I'd love to do one so that I could, get familiar with the process, but haven't had anybody with that need, but that program is out there.
Okay, great. So here, this is a good transition because you just said something. That loan is not for investors. So now let's get into that a little bit. These various loan products, which one applies to, or which one would an investor qualify, and which one do you have to be an owner occupant? In other words, someone that's actually going to move in and live in the property.
So your conventional loan product, if you're an investor looking to buy a second home or an investment property, conventional is the only loan product that you can take advantage of. FHA, VA, and USDA are for primary residence only. So you have to occupy that home customarily within 60 days after closing and claim it as your homestead. Okay. So yes, if you're looking to purchase a second home, and a second home is considered a home aside your primary residence that you plan to visit from time to time throughout the year. So let's say I live here in San Antonio. I want a house off the coast. I'm not planning on renting it out. It's going to be a home for me and my family that we're going to visit back and forth, throughout the year or in the summer. That's considered a second home.
Okay.
And down payment requirements are different. Usually you've got to put 10% down. Okay. But if you are interested in purchasing an investment property, your intent is, yes, I'm going to rent it out, then the down payment requirements are higher. You've got to put 20% down.
Right.
Customarily on investment properties.
Okay. So just to be clear on this, if you are an investor, you're going to have to go with conventional financing, 20% down, and that's it. If you're going to put 10% or 5% down, you have to be an owner occupant. And I think you said if it's going to be considered a second home, you have to put at least 10% down.
Correct.
What do you know? What the required? How many days do you have to live in this home for it to be technically considered a second home? Do you have that information by any chance? Because I thought I'd heard it was maybe 14 days a year, or I don't remember.
I have never seen a definite amount of days or anything like that in the guidelines. It just, it will say, a home that you plan to visit. There might be a certain amount of months out of the year. I'd have to look it up.
Yeah.
But it's got to make sense. And usually it does. If I live here in San Antonio and I want to buy a house down in Corpus, and I don't plan to rent it out and it all makes sense, then
it's kind of like you're like you said, you have a house in Corpus, you frequent Corpus a lot, so you need a place to kind of second home, really. It's what it is.
Right.
Somewhere that way you don't have to stay with friends or family or rent a hotel or Airbnb. Or
exactly. Yeah.
Okay. So on the investment loan, 20% down. Now, I know you and I have done several loans together, whether it's representing clients or me. I'm your client on several of my purchases, refinances, and I know it gets real complex when you start adding properties and all that stuff. So I know that as you start to accumulate rental properties, there's also some cash reserves required, right?
Yep.
And and correct me if I'm wrong, but I think I remember that loans like 1 through 4, you have to have like 2% of the unpaid balance is what I remember. And then loans, and then when you get to property 5 and 6, that's 4% of the unpaid balance. And then property number 7 through 10, now you're up to 6% of the unpaid balance.
Yes.
Is that about right?
That sounds about right. I don't know them off the top of my head, but yes, that sounds about right. So the more properties that you own, investment properties that you own, you need to be prepared to show that you have reserves.
Right.
And like you said, how do you calculate the amount of reserves that I need? It'll depend, like you said, on the number of investment properties that you have financed. And then it'll be a particular percentage of the unpaid balance of each property that you own.
And just to tell the audience, if you go to my YouTube channel, I actually recorded a small video or a short video where I kind of go on that, and on that video, and I explain the different percentages. I think I got them correct, but I don't quite remember exactly for sure. But check that video out. I explain it. I even get on I share my screen and I show you exactly where you find that in Fannie Mae. I don't know if they call them rules, regulations.
The Fannie Mae guidelines.
Okay, the Fannie Mae guidelines, because I think you gave me that information. That's why I have it. I have it. There's one of my favorites on my browser. But okay.
Yeah. And as you know, as the investment king, I'm sure you preach it all the time. If you're looking to get into, investing, you gotta have those reserves, because they're going, even if you're just going to buy your first investment property, you got to have some reserves, because the lender needs to see that not only do you have the funds to cover your primary mortgage payment, they want to see that you've got so many months in reserves to cover that rental property should, worst case scenario. Let's say you can't get a renter in right away. Let's say you've got to, you can't rent it out right away because you're going to do renovations or fix it up first. I'm not too sure how you guys do things, but if anybody were to ask, what is the reason for that? Well, simply because, the lender wants to feel, pretty good that you've got money in the bank should you have to carry those 2 payments, until you get somebody in there.
They want to be reassured, obviously, that that you can operate and you have the capital to do what you said you're going to do, right? I know that the very first property that I bought, and I'm sure the underwriters, obviously, they saw that I had never done this before. This is the first time I'm buying an investment property. Yes, I did put 20% down, but the property did not have the stove, the refrigerator, and the dishwasher. One thing that the underwriters told the lender is, we need to know how much is it going to cost to put those appliances. So I had to go and find out how much these items were going to cost. And I think if I remember correct, it was like, I don't know, 20, 21, 22, 2,300, something like that. And I sent the lender a small spreadsheet, and I don't remember if I actually went on, say, like Lowe's.com and actually priced it and sent them, the information so they could confirm or verify what I was saying was accurate. But I sent that information in, and the underwriter said, all right, we want that money to be escrowed. So they wanted that additional money to be escrowed before I was able to close. And what they did is, after I closed, they gave me 2 weeks to purchase those items, put them in place, get it operational, right? And then I think they sent an inspector before I was actually given that money back.
Yeah, they probably did an escrow holdback. Did the title company held on to it?
Yes.
Yeah. So that's called an escrow holdback, where yes, if the lender, if there are still some things that need to be done, customarily that's done on a new build sometimes when the sod isn't going to go in. Let's say you're in a state where there's a lot of snow, so they're not going to put the sod in yet until after you close. Or like in your case, you weren't going to have appliances in right away. Well, the lender allowed you to do what's called an escrow holdback, where the title company held that money and waited for you to do those, put in the appliances, and then yes, we have the appraiser go back out, confirm yes, and then they pay you or reimburse you back, or give you that money that's in the escrow holdback.
Yeah. And I wasn't really given a reason other than, hey, this needs to be done. That's it. Right. I'm assuming that because I've never done this before, it's my first time. Maybe that's why. I don't know. All I remember is they say, hey, you need to do this before we close. The good thing is we're able to get it done, got it closed, got our money back, so everything worked out. All right. So you've mentioned a few times DTI. Explain what DTI is.
So DTI is an acronym for debt to income ratio. Debt to income ratio is basically how we determine how much you qualify for based off your existing debts that we're looking at on your credit report and your income. So to determine your DTI, debt to income ratio, we take your existing debts off your credit report, the monthly payments, plus the new estimated payment of the amount you're looking to borrow. And then we divide that by your gross monthly income. And that magic number is your DTI. And we want to see 49% or less. Really, we want to see 45. 45 is ideal. 49 is the max that you can go. Anything above that, then we're over obligating you and we need to restructure. We need to talk about, you either need to lower your amount that you're looking to borrow, maybe pay some things off, maybe add a co-borrower with additional income to help lower that debt to income ratio. But that's what debt to income ratio is. You got your front end ratio and you got your back end ratio. So we look at both. Your front end ratio is just what is the ratio just with the new house payment and your income. And then your back end is all your debts plus the new house and your income. So sometimes you'll see DTI 31/45. That means if you see that in the guidelines, that means, the front end ratio can't exceed 31%. And then the back end ratio with everything combined can't exceed 45. So that's debt to income ratio. And again, that's how we determine how much you qualify for as far as a mortgage is concerned.
Okay. So is those percentages you say, you said, I heard you say 49% and 45%. Is that for all loan products? Is that for owner occupant, or is that for investors? Can you explain that a little more?
Yeah. So DTI is going to be different with every loan program.
Okay.
And they're not really set in stone. You can get away with higher DTIs if you've got good compensating factors. But then there's some loan products like your USDA. They're pretty adamant, pretty set on a 31/46, 46 debt to income ratio. If we go above 46, more than likely we're not going to get you approved for USDA. We're either going to have to, again, lower the price, pay some things off, or put you in another program. FHA likes to see you at a 45, but you can get away with a 49, 50, sometimes even a 51 DTI on an FHA. Again, you'll see that happen with stellar credit, someone with a 7+ credit score. They have plenty of reserves and assets. The system picks up on that, and it'll allow us to go higher versus someone that might be in the low 600s, very little money in the bank. More than likely, the system is going to cap us at 45. Okay. So, are they set in stone? No. So it's every applicant is going to be different. It's just going to depend.
It's just too many variables, right? Too many variables to really.
Right.
Yeah. Okay.
Right. VA, now VA is a little bit different. VA does not have DTI per se. VA is the only loan product that is more concerned about residual income. So on a VA loan, we have to calculate your residual income. The VA has a chart that says, okay, for the South, okay, we're in the South for a family of 1 or 4 or 6, whatever, there's a certain number residual requirements that the VA wants. So you can have a very high debt to income ratio and still get loan approval, because if your residual income is really good and is not below the required, more than likely you're going to get loan approval even with a high DTI, because again, VA is more concerned about residual income. Residual income is how much income does the veteran have left over after we deduct the taxes from his gross pay, deduct his monthly debts on his credit report, plus the new payment. Whatever that bottom number is, as long as it exceeds or is not below the required that VA wants to see, then you can usually get loan approval even with a high DTI. So VA really doesn't have a DTI requirement. They're more concerned about residual.
Okay, great. Wow. I never heard of that. Thank you. Thank you for sharing that.
Yeah.
What about on now, again, we're kind of, my show's kind of geared towards investors. What about on the investor side? Is there a certain percentage? Is it 45, 49? Is there anything set in stone? Is there some, or does that also have various variables that come into play?
On investment properties, I do believe the DTI criteria tends to get a little bit stricter.
Okay.
Once you start getting to 49%, it gets more difficult to qualify, because now you're kind of pushing it. But if you got a really good DTI ratio, 43, 45, you got strong scores, you meet the reserve criteria, usually you'll get loan approval. But when you start getting a little bit higher on the DTI, for investment properties, it gets a little bit more difficult to qualify. So you want to be sure that you've got the income to satisfy, what the next property that you're buying, and that you've got, assets and reserves in the bank.
So I guess these loans are, I would assume that the lender's looking at, these are riskier loans, right? Because these are investment loans. It's not a house that necessarily the buyer's going to live in. So a little bit higher risk, I would think. Yeah.
And that's the reason for the larger down payment.
Right.
I do have people ask me, why so much down? Well, like you said, it's a little bit more risky. It's not your primary home. And so, the lender wants to see that you put some skin in the game yourself, just to kind of offset the risk.
Right. Yeah. So, and you said 43%. I had heard that a long time ago from another lender. So I've got that ingrained in my mind. And that's always, if I'm looking at that next property, that's the first thing I'm doing is checking, okay, where do I stand with my DTI, including obviously the subject property that I'm looking at. And that's what I tell my clients as well, that are investors, is that 43%. If we can be at that 43 and below, chances are you have a very good chance, as long as everything else is in place, able to qualify. Right.
Yep. That is a good rule of thumb to go by.
What about employment history? What can you tell us about that? Because if someone I've always heard that you gotta kind of have an employment history of at least 2 years, probably in the same profession or line of work or whatever. Can you explain that a little more?
Yeah. So there is a misconception out there that you have to be at your current job for 2 years. Okay, that is incorrect. We want to see 2 years of employment history. Okay, so it is okay if you've changed jobs, or it's okay if you take on a new job or you just started a new job, as long as you've got 2 years of work history. That's what we're concerned about. Now, if you change jobs quite often within the last 12 months, then it gets a little bit difficult to qualify, because We like to see consistency, or we like to see, job stability. But again, we're looking at 2 years work history. Okay. You don't have to be 2 years at the same employer. Okay. So that's where employment history comes into play.
Okay, great. Yeah. Thank you for sharing that. All right. So now let's get past the approval process where we found a property, we qualify, we're under contract. Now tell us about those do's and don'ts while you are under contract. Because I know sometimes that I'm sure you've seen it on your end a lot more than I have as a realtor, but as a lender, I'm sure you see a lot of things that happen that end up kind of making the deal fall through.
Right. So your dues, of course, you want to get fully pre-qualified before you even start your home search. Okay. Make sure you know what your budget is, make sure that you're good to go. You've met all the lending requirements for loan approval. You want to start a savings plan. You want to keep your personal documents handy, start getting them ready. W-2s, pay stubs, bank statements, tax returns if you're self-employed, or if you've got investment properties and you file a Schedule E or whatnot. And then, and the don'ts. So once you're under contract, okay, don't go making any huge purchases. Don't go buy that car that you were waiting, to buy. Don't run up your balances on your credit cards. Don't apply for new credit cards. Don't co-sign for anybody. And don't change jobs or resign or quit.
Yeah.
During the process, those are the major things, big purchases, job changes. I mean, if there is a job change in the middle of your process, notify your lender right away, because we need to know, and we will know. We do a verification of employment a few days prior to closing, to ensure that you are still employed the day of or before closing. So if you're going out and applying for credit while you're in the process, we do get notifications of inquiries. Yeah. And then we will reach out to you and say, hey, Ruben, we noticed that there was an inquiry at Lowe's. Did you open new credit? And you have to tell us and sign, a credit inquiry form. Well, yeah, I did. I wanted to start buying all my appliances. And did you put a balance on it? Well, yeah, I did. Okay. So now that's an undisclosed debt that now we have to add and make sure that you still qualify.
Right. Yeah.
So, I know a lot of homeowners, the home buyers, they get excited. They want to start buying furniture right before they close. And I tell them, please don't do any of that. Don't go opening any new credit until after you've closed. Again, don't co-sign for anybody, because, now we have to count that debt as well, because you have agreed to, you are obligated to pay that loan should that other person not pay it. So we have to include that debt. Right. So, don't go co-sign, don't go buying any, big purchases. Don't go open any new credit. Don't have any insufficient funds or returned checks. A lot of people don't think about that, but when we look at bank statements and there's quite a bit of non-sufficient charges and they do show up on your bank statement, the underwriter will require an explanation. They want to make sure that you're not financially struggling, and so, keep your bank accounts clean. Don't have any return charges or any return checks that might alert the underwriter and require explanations from you as to, what are all these overdraft fees, what caused them. So those are the don'ts, while you're in the process.
What about the large deposits? That's
right.
I think you said that to me one time.
Yeah. So that's another thing too. don't be making too many large deposits or transfers back and forth, because when we're in the process, we have to source where your money is coming from. Okay, so that's the reason why we ask for your last 2 months bank statements, because we want to verify that you have the sufficient funds needed to close. But also in doing so, we're also going to review your transaction history. And if there's any large deposits, and large deposits are usually a certain percentage of whatever the sales price is, anything of that amount or higher, we'll consider large. We have to source it if it's not evident what it is. Like, more than likely, if it's payroll, of course, it's going to say, your employer. If it's Social Security, it'll say Treasury, if it's your VA benefit. But if there's just deposit $10,000, we're going to ask you, what is this deposit? And you have to explain, and we have to source it. Now, you may have to you'll have to show proof. It's checks, multiple checks. Okay, we need copies of all the multiple checks. If it's cash, then it starts getting really difficult at that point, because it's hard to source where cash came from. And so, believe it or not, there are a lot of people that have money under the mattress. They have money at home that they're still holding on to. And so I do have this conversation, you want to deposit that money in the bank as soon as possible, because that money has to be seasoned for at least 2 months in there. If not, we see a recent deposit, we're going to ask for it, ask what it is, and you have to source it and provide proof as to where that money came from.
Right. Yeah.
So,
I had a situation one time where I had some damage in my home. I filed an insurance claim, and I got reimbursed like $17,000, and I actually had deposited that check into my account, and then I guess it was like a month later, I was under contract on a property, and when I gave them my bank statements, they saw that, and hey, what's this? And I had to, like you said, I had to prove it. The good thing is I had a copy of the check. I think I even had some paperwork from the insurance company. So it all worked out, right?
Yeah.
But you're right. I had to explain, where did that money come from, right? So,
yeah.
But,
and it's just part of the underwriting guidelines to make sure that, of course, your funds are legit, really. And you just got to source those large deposits, just to ensure that we know exactly where your money's coming from.
Okay, great. Hey, Andrea, man, this conversation's been great. Thank you so much for everything you've shared. I know there's so much more that we could be talking about, but I mean that we could be in here for 2-3 hours and just because there's so much involved, right? We barely touched on loans and the approval process. We barely touched on it because I know it goes even deeper, right? There's a lot more that's involved, especially when you start talking about investment properties. You and I have been through a lot of transactions together, so I know it goes a lot deeper than that. But I kind of wanted to get some just basic information. That way, the listeners out there can, learn a little bit more. And if somebody wanted to get a hold of you, Andrea, how can they reach out to you and ask you about getting pre-approved or helping them with the loan product?
Oh, yes, most definitely. They can call me direct at 210-857-4839, or you can email me. It's very easy. It's my first and last name, Andrea Lopez @loandepot.com. I also have a site. I have a Facebook page. You can find me on LinkedIn, and you can find me on Instagram as well. So, yeah.
Great.
Call me, text me.
Yes, and what I'll do is I'll get all of Andrea's contact information, all her links. I'll put them in the show notes. That way you can just click and automatically get to her. Is there anything else, Andrea, that I might have left out? Anything else you want to share that's important to the listeners out there?
Yeah, I mean, you left out down payment assistance.
Oh,
my favorite.
All right, let's talk about that. Yes, that's important. That's very important.
So, I do a lot of down payment assistance programs, so I'm very knowledgeable in the programs that are out there within the state of Texas. So if you are a first-time home buyer and you need help coming up with your minimum down payment, there are programs out there that would help with your down payment. They do have credit score criteria that must be met, and they do have income limit criteria. So these programs are to benefit low to moderate income families. So that's the reason for the income limits. And then the credit score criteria is 620. So all borrowers must have a 620 to take advantage of these programs. They're great programs out there. They will grant you 3, 4, or 5% of your loan amount to use towards your down payment. Okay. And then there's different types of grants. So there's a true grant where it never has to be repaid. They give you the money, you move on, and it's free money. And then you've got a 3-year forgivable. So a 3-year forgivable, they grant you the money. And as long as you don't sell your home or refinance within the first 3 years, it is totally forgiven on the 3rd year. Okay. So it's a silent second lien is what it's called. You do not make monthly payments towards the amount that you were given. You don't earn any interest off the amount that you were given. It just sits silently aside your first mortgage. Okay. But those are great programs. The city of San Antonio does also have programs as well that will loan anywhere from $1,000 up to $15,000 to help cover not only your down payment, but your closing cost as well. So there are programs that the city of San Antonio offers. And so you want to take advantage of those early on in the year, because they do tend to run out of funds. But there's programs out there as well that the city offers as well. There's income limit criteria. They don't have any credit score criteria. As long as the lender gets you approved, they're okay, as long as, you meet their income limit criteria, and then the additional criteria that they're going to require as far as the property and so forth and so on. So there are programs for those folks that maybe have very little or no money for their down payment, or maybe just have enough for down payment and not the closing cost or whatnot. That's a good time to take advantage of those down payment assistance programs.
Okay, great. Wow. See, like I said, there's so much more that is involved in this. It's just a lot. So thank you for sharing that. I'm sorry, I was forgetting about that.
No, that's all right.
I know you've helped me and some of my clients with that. So that's real important for some folks out there that can take advantage of those type of programs. So, all right. Well, great. Well, God, that was fun. I hope you enjoyed it. It was a lot of fun, and I want to, hopefully in the future we can maybe do another show and maybe kind of dive deep into maybe the these programs you talked about. Maybe we can kind of dive deep into that, or maybe some other things as well. But I would love
most
to
definitely
do that in the future.
Yeah, I can talk mortgage all day long.
Just like I can talk about investing all day long, right?
Yep.
Well, hey, I hope everybody has enjoyed this show. If you want to reach out to me, I'm a real estate investor. I'm also a real estate agent in the San Antonio area. I can be reached at, go ahead and email me at ruben.galindo.safr@gmail.com. You can also go to my website at www.sanantoniorealestateinvestors.com. Schedule a call, reach out to me on Instagram or Facebook. Send me a DM and we'll connect, and I'll try to find out, see how I can help you. Hope you enjoyed this show, and please like, share, and subscribe so you can get more information on real estate contact. All right. Appreciate you guys, and we'll talk later.
Have a good evening. Bye-bye.